Paying your credit card off in full every single month, banks actually like you less for it. There are two main types of credit card users, transactors and revolvers, but one makes banks more money than the other. By the end of this video, you'll know exactly who banks make the most money from, the shocking profit difference between these two groups, and why this actually matters a lot to you. Here's the difference. Transactors pay their full balance every single month. They represent about 36% of users and tend to have higher incomes and excellent credit scores. Revolvers, on the other hand, carry a balance from month to month. They make up about 40% of users and end up paying 20% or more in interest. Interestingly, transactors actually earn more and spend more. On average, they come from households making $134,000 a year compared to $72,000 for revolvers. And transactors are responsible for roughly 40% of all credit card spending. So most people fall into one of these two groups: 36% transactors, 40% revolvers, and the rest are low users or dormant accounts. So if transactors have higher incomes and spend more, why do banks treat them differently? It all comes down to one thing: profit. Banks make money on credit cards in four main ways: interest income, interchange fees from every swipe, late fees and other penalties, and they also have to pay out rewards. But here's the big secret: nearly 80% of all credit card profits for banks come from interest. Interest is their golden goose. Interchange fees, the small fee merchants pay when you swipe, are much smaller by comparison. In fact, after paying for all the rewards and points they give out, transactors are often low profit or even net negative for the bank. Here's the profit comparison that will blow your mind. On average, a revolver brings in about $240 in profit per year for the bank. A transactor, only about $25. That means banks make 8 to 10 times more money from revolvers than from people who pay in full. Last year alone, Americans were charged over $160 billion in credit card interest. The majority of the banking industry's credit card profit comes directly from revolvers. This is exactly why you're constantly bombarded with 0% APR offers and balance transfer checks. The banks are trying to turn you from a transactor into a revolver. So here's the key point: paying in full doesn't make you less valuable as a customer, it just makes you less profitable to the bank. And that's actually a very good position to be in. In the next video, we're going to cover why you should still pay in full, how to actually beat the banks at their own game, and the best strategies for transactors. Like this video, subscribe, and turn on notifications so you don't miss part 2, and drop the word transactor in the comments if you pay your card off in full every month. I'll see you in the next one.